All right, term life premiums. Back to term life premiums. Oh my God, that's great. I forgot he was back there until the Jets turned on. Anyway, look, with these term life premiums, skip the whole first paragraph, jump to the second paragraph. Let's not even talk about the fact they started the second paragraph with the word because. Who starts a paragraph with because? Who taught NAIFA, the National Association of Insurance and Financial Advisors, how to write? You mean to tell me we got to take everything they say at face value when they start paragraphs with the word because? Man, I'm going to send them back to 5th grade. But anyway, enough of that. Highlight the probability of death increases with age. Premiums also increase with age. Durr. Go down to the bottom. 4 lines up from the bottom. Check this out. As if we didn't know, if the policy is renewed, the premium is adjusted upward, reflecting the higher rate for the increased age, and will remain level at that amount for the duration of the renewed term. And then highlight right under that step rate. Circle the step rate. And then look at that illustration right there. David, draw me a step. Doot, 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 doot. Right? So imagine. Let's go with that. Look at that illustration they have. So I have a 10-year term. It runs $100,000 for 10 years. At the end of that 10 years, it's renewable, right? I'm 10 years older. They calculate that for the new risk. My premium is up. Did I increase my benefit? No. So for the next 10 years, so I had a level premium for 10 years. I renewed it. It went up. Then it stays level for another 10 years, right? Because I didn't increase the premium. I go to renew again. It goes up again, but the benefit stays level. Step rate, do you see it? Step. Every time I renew, the premium up 1 notch to accommodate the higher risk. But we did not increase the benefit. Step rate. And like that, term life insurance is done. So let's transition, right? So we understand term life. It's only there for a short period of time. We know that the smallest, most basic version of it is an annually renewable term. It's the least favorable because every single year you're being renewed at a standard rate, but every year your premium ticks up a little bit. Why? Because you're 1 year older. Okay? Now, what other type of policy? So we got that most basic type. And then we've got a couple of other types here. What do we have? We have a level term, which is what we've been discussing. Every single time we bring up a $100,000 benefit, it stays consistent until the end of the term. What other types do we have? Well, we have that decreasing term. And the example we gave for that was mortgage insurance. Because a mortgage insurance is usually a pretty long term, right? 30 years is typical. So if we have a 30-year term, as I'm making payments off of that, in 10 years, if I bought this house for $100,000, in 10 years, do I still owe $100,000 or I pay a chunk of it off? If I was to die, or let's just say it was your house and you were to die, do you want life insurance policy to collateralize my loan? And then God forbid something happens to you, instead of paying me what you owe me, you pay me 100 grand despite the fact you may only owe me 70? You would never do that. So a decreasing term is designed to stay in sync with the loan amount. So that way you're collateralizing what you owe. Now on the flip side, if the decreasing term is keeping in sync with the payments you're making, then increasing term is keeping in sync with inflation. Because $1 today does not equal $1 tomorrow. So the increasing term policies are tied to a consumer price index, which identifies how much more insurance we would need to buy to be relevant in the future. Now we had that option to renew. That means that we did not have to provide evidence of insurability, but if we wanted to, it would be because we were trying to get a preferred status on our premium rating, which would be a better price on the premium, correct? Yeah, look at you, you got this, you got this. The other one was option to convert. And then this is here, we're gonna slide into the next section. Why? Because we're done with those temporary policies. That policy, that temporary one, that's good for people like you and me. the entrepreneur. Let's talk about our earning years, right? Who's that policy good for? Well, right now you're getting your license. In a couple of years, you're going to have a book of business, okay? Right now, during that risky time, maybe you have to pay for a house and a car and all these other things. So you get a term policy because it's inexpensive. Why is it inexpensive? It's because it only provides you insurance coverage, which is the death benefit. Of course, we're going to talk about in the other chapter how you can modify it, but in general, it's only providing you a death benefit. This whole life thing, it's actually combining the death benefit with the savings element, okay? So that's the reason why somebody would convert a temporary policy with a time frame, because they're going to move that money or move this coverage into a whole life policy that covers them until age 100. Check this out. Let's go to page 89. Now, before I jump into this, I want to make sure you guys know whole life. Remember on the other page where I was talking about ordinary life, and I was telling you that ordinary life was just this general term that everything that we're talking about is going into? On this one here, whole life is somebody's name. It's that policy's name, okay? Like me, I'm Jason. That's David. We got a Julio back there sleeping like the guy we saw selling the coconuts at the beach, right? Oh, he taught class first, man. It was funny. Anyway, so watch me get out there. I'm gonna shave my chest like Austin Powers and sit in the background. Sit in the background of his. But so look. I just wanted to make sure. Whole life insurance, we're going to talk about whole life. We're going to talk about universal life. And we're going to talk about variable life. These policies, we're not talking about one whole life policy that we're modifying a few times. These whole life is the name of that policy, okay? It is the most basic version of policies. This is basically the boomer's life insurance policy. This is from back in the days before they knew, that you could go ahead and modify these policies to do a lot more. So let's go ahead and start throwing shade on whole life. It's like universal is like the hot friend. Whole life is the not hot friend. It's like I got this all swollen millennial over there, right? I guess David would be the universal product. I would be the almost boomer whole life. I'm better looking than he is, though. He's just swollen. Like he's allergic to air and everything. I don't know. Yeah, so all right, look. Features of whole life. Seriously, this whole section can be summed up in this next line. Go down. Once again, that's the title, right? So we're just talking about the thesis here. So in 531, take the headline, features of whole life, and then first line, features of whole life. And then next, cash value and maturity at age 100. Right under that, let's go. Take that headline, 5311, cash values. From here on in, everything has a cash value. The only thing that doesn't have a cash value are those term policies, okay? So on this cash value, at the end of line 1, whole life insurance combines insurance protection with a savings element. So I jumped over that or accumulation. We don't need that. It's a savings element. We get a savings element, right? Put your money in the bank, you save it. It's there. You take it out, you can use it. You can borrow against it, can't you? But the bank can never take it from you. They can never force you to surrender it or forfeit it to them. Same thing with this policy. Cash value is yours. All right? So let's see here. We highlighted that first sentence there. Whole life insurance combines insurance protection with a savings element. And then after that, highlight cash value and underline it. Okay? So the cash value is a reflection of your savings element. That's all it is. Next paragraph down, highlight end of the first sentence there, cash value. And then under that, represents the amount of money the policy owner will receive if the policy is ever canceled. And then right under that, next line, cash surrender value. All right, now go over next page. Maturity at age 100. That makes sense because I'm 49 and I'm nowhere near mature. So maybe in another 51 years I have this covered. But what this means is that on a whole life policy, remember, term was only covering you for a short period of time. How many of us are going to hit the healthy 100? Not many of us. So a whole life is basically insinuating that you're going to be dead by 100. So let's just go ahead and make the policy term end at 100. So you could be paying into this thing almost an entire lifetime. At age 100, the premiums that you made and the cash value that was accumulating actually equal the benefit amount. There's no more reason to have your money. When you turned 100, you had $1 million policy. Well, great. You deposited $1 million and didn't get nothing for it. Here's it back. True story. True story. I didn't make it up. I just painted it differently. Right? So look, maturity at age 100, highlighting that first line. Whole life insurance is designed to mature at age 100. See, right under that. Assumption, every insured is presumed to be dead by then. Skip the next line. Kind of one line after that, right in the middle. Premium rate for whole life insurance is based on assumption, policy owner will pay premiums for the whole life. Later on in that sentence, at age 100, the cash value has accumulated to the point that it equals the face amount of the policy. No more reason. You wanted $1 million bucks? There's your $1 million bucks. Congratulations. Happy birthday. You don't have to make premiums anymore. Where are you going? Disneyland. Like Blue from Old School. What is my time, millennial? 12 minutes. All right, so look, let's talk about these living benefits. Where am I? Where am I? Living benefits, page 90. We're going to start it at the bottom, right? So let's look at here. Started from the bottom, look at here. So 5313, living benefits. Then go into first line all the way over where it's bold and highlight living benefits. And then second line down through the cash value. Next line down, policy owner has a ready source of funds that may be borrowed at a reasonable rate of interest. All right, why don't you whip out your pen and underline may be borrowed. Cash value, underline cash value may be borrowed. At the very end of that page, last sentence, it is not a requirement of the policy that the loan be repaid. If outstanding at the time the insured dies, loan plus any interest due will be subtracted from the death benefit. Next paragraph down, life insurance is considered property. Next sentence down, check this out. Remember depreciating term? It may be used as collateral for loans, mortgages, right? So let's look at this whole life premiums. After these messages,